Neelkanth Mishra, Head of Equity Strategy India at Credit Suisse, joins us. He's our market master for the day. Good morning, Neelkanth. Pleasure having you today with us. Thank you very much. Well, first up, are you getting fresh growth scares? That Tata Motors commercial vehicle number was none too good, and is that giving an indication that those green shoots that we have been waiting to see in the Indian economy are not quite shooting up?
Yeah, so we've always held the view that the growth won't accelerate, and that the worst is past, that there were lots of factors which were dragging down growth, including things like the grid failure of 2012, the problems with iron ore mining. Some of them are still continuing, but mostly, hopefully, the worst is past. There was the issue of the creation of Telangana, which was holding back investment in a very large state of India. There was a fiscal drag. Lots of these issues had brought down growth to artificially low levels, and I think we've seen a bounce back from those. Now, on a year-on-year basis, if you look at monthly numbers, sometimes they can mislead. We were also of the view that the 5.7% growth that we saw in the June quarter, the GDP growth, was slightly overstated given seasonal effects, that this year the monsoon was bad. Last year the monsoon was pretty good, and so June saw much stronger construction, July saw much stronger construction as well. But we have seen some of that come back to normal. So if you look at cement demand growth, for example, for the whole quarter it was just 6-7%. So I don't expect the GDP growth to accelerate to very high levels, and from that perspective it will be a nice and tepid recovery. I don't think we will see very sharp moves. So I'm not surprised that some of the numbers have started to normalize.
Hi Neelkanth, good morning and thanks again for joining in. What does all this mean for the equity markets? In the month of September, we were meandering. In the next 6 months, how do you expect Indian equities to perform?
You know, this is where it's useful to look back and see why the market has done well. And we have consistently held the view that it is global factors which are helping the Indian market much more than the local issues. There were two very isolated, I would say, focused tail risks. One was the government, and the second, the currency, which would have prevented someone from taking a longer-term positive view on India. And both of these have been mostly addressed. So the tail risk of there being a crisis and the government not being able to manage it, I think, is well and truly addressed. Some people have gone to the other extreme. And the currency aspect, I think, is more or less sorted out. So both of these risks gone. The fact that India is miles behind other emerging markets, there are lots of low-hanging fruit. The growth in India can be much stronger than in most other emerging markets. Means that the broader market should continue to do well. I think the view that people have that with the change of government that drove up the markets is I think not completely true. If you look at India's P premium, so MSCI India's price to earnings multiple, and if you measure the premium of that to MSCI World price to earnings, that has barely moved up. So it used to be much higher just 3 years back, and it has just bounced back from very low levels. So I think the global factors matter a lot more. I don't expect the local disappointments to mean much. Now, from that perspective, we are going through a period of readjustment. So we put out a note just before we went into the long weekend where we showed that while the Indian market and the Indian currency are looking relatively stable, there is significant turmoil in many other parts of the global markets. So markets in Australia, Brazil are down 17-18% in a month in dollar terms. Not all of it because of the currency. The local markets are down a lot. All the commodity exporters, South Africa, Canada, Brazil, Australia, have seen a very significant weakening in the markets in September. The currencies have fallen as well. Partly, I think, and this is a narrative that we have to put on some of these isolated data points, which I think is because of slightly weaker views coming through on medium-term outlook for China. There's also been the strengthening of the DXY, the trade-weighted dollar, and that has also led to some currencies which had not, the economies like say Turkey, which had not seen an improvement in the current account, the currencies have come down sharply. We have not seen that in India, so we think everything is normal. But out there in the world, there are lots of adjustments happening. So far, this is a very orderly adjustment. So there are very few contagion risks, but we need to stay watchful. If any of these contagion risks snowball into something which is uncontrolled, say a bank failure or some large company going down, and there being significant risks of counterparty risks which slows down trade, etc.
Okay,
now
that is
those
still
risks right now, if they don't emerge, the market, I think, so to answer the question, it's a very long convoluted answer, but it's important to see all the facts that if that does not happen, I expect the market will keep doing well. I expect that the earnings growth in India for the index will be 10 to 12% at least, if not higher. And that on a 6-month basis just delivers 6-7%. Price to earnings can still improve from here. It is not very high. And I think the broader market will continue to do well over the next 6 months. Sorry, Lata, you were saying something.
That partially answers my question as well, but nevertheless, just to reiterate, you don't fear a drying up of liquidity, do you? The manner in which we have seen funds kind of evacuate commodities. They've almost fled from a large number of commodities. As well, emerging markets didn't get too much money. In fact, was it in the seven-month low that you were saying in terms of flows into emerging markets? So a liquidity drought is not something you're factoring in, which might therefore have collateral damage on India?
Not really. See, one fact is that the quantum of FII flows historically has had very little correlation, except for very isolated pockets. It had no correlation with the direction of the broader market. So we shouldn't worry too much that if there are 2 months of no flows and the market tanks. I don't think that's going to happen. I think the part of the reason the commodities have corrected is supply, and part of the reason is demand. So for example, in oil, you may have seen a lot of these news items talking about the cartel potentially breaking up. Now, whether that is not breaking up meaning for good, but at least the price discipline, that the production discipline in oil seems to have broken up, maybe because there is a big supplier, maybe a big producer like the US which has come in, and the demand projections have been revised down. The same thing is happening in iron ore, and this is where, let me tell you that the financial investor plays a very small role. The financial investor plays a much bigger role in smaller commodities, like say aluminium or zinc. Like in aluminium, there's 45 million tons, $2,000, $90 billion of annual consumption, $2-3 billion that come in, which is a pittance in the global markets. And suddenly aluminium starts moving up. In oil, that consumption number is $3 trillion. In iron ore, there is very little financial involvement. So it is demand supply, and we have seen in iron ore as well weakening of Chinese demand. You may have seen the World Steel cut their growth estimates for 2014-15, mainly because of China. And this is happening, unfortunately, for the iron ore producers at a time when there is a lot of iron ore hitting the market, and it's very low-cost iron ore as well. So these are factors which have brought down commodity prices. There is, you're right, somewhat of a tempering of the view, or even on the non-ferrous metals where financial interest was high. But broadly, it is, I think, not yet a view of low risk. See, if it is risk aversion, then India is at risk.
Okay. But that's not the case yet.
Reflection of that is not the case yet. Exactly. Yet is actually the key word here.
Okay. Let me get your view on individual stocks and sectors as well. Q2 is expected to be a good quarter for the IT sector. Would you recommend a buy on any of the IT stocks, at least in the large cap space? And if yes, which one ahead of the earnings season?
So the sector as a whole we've been constructive on, and we got slammed for 3-4 months because there were other sectors which were significantly outperforming. Thankfully, that view has changed. I think the sector as a whole is our biggest overweight. We expect that earnings will look good. I think the commentary, which sometimes matters a lot more, will also be quite constructive. There will be some currency adjustments that will need to happen. See, we have to understand that a lot of these companies, while they still remain focused in the US as the largest market, they do have exposure in other geographies, and they will be, so long as all the headline numbers are in dollars, there will be some hiccups that can happen because of the sharp fall in the euro, for example, or the changes in the pound. And so that can create some hiccups. But I think in terms of the sheer volume growth, I expect that over the next 6-12 months, this sector will continue to do well. Part of that reason, so when we put out this note recently called Basket of Abundant Growth, where we talked about how while India is compared to other emerging markets in headline numbers, and we also think we are like Brazil or Mexico, the reality is that in per capita GDP on PPP adjusted terms, even if you take sort of the country adjustment out, Mexico was like India in 1976. Brazil was like India in 1983. Turkey was like India in 1983. These are economies which are decades ahead of India. And their growth rates reflect that. So I think India is like a sub-Saharan African economy with a developed world political system. So that is a very attractive part of the market. Now, so growth, unless we have artificial drags, as I mentioned earlier, the sharp reduction in iron ore mining or the grid failure or something, I think growth should be much higher than in other emerging markets, and therefore we should keep attracting good investments. Now, where to invest? It's one thing to say India is a basket of abundant growth, but where will you invest? And we highlighted 3 parts to that. One of them was exports. That the rupee, after 14 years in the 40s, spent about 2 years in the 50s and now in the 60s. I think ages very fast. What that does is, if you look at the entry-level engineer salaries, that is back to 2005 levels in dollar terms, and there is no dearth of them. So there is an enormous opportunity for the IT sector to leverage on that. The sector globally is also seeing higher capex, and I think that that trend should continue. There are other sectors, like I think agri is another sector which benefits a lot from the weaker rupee. There is also a second angle, which is wholesale funding rates. So for the longest time we had a big current account deficit. We were struggling to match it with capital inflows. This year, I think the surplus when we put out the note, it was about $40 billion was our estimate for the BOP surplus, which is massive. And this is the highest since 2007. Now with oil being where it is, my sense is this could be $50 billion. And that means that wholesale funding costs come down quite sharply. So everyone who's wholesale funded, so some NBFCs, wholesale funded banks, I think we'll see good growth. So that's the second aspect of growth. And third is discretionary consumption. And there is a secular structural aspect to it. There is a partly cyclical aspect to it. Just like when we explain that in equity markets, if you look at 1-year returns, they're exceedingly volatile. If you look at 10-year CAGR returns, they're not that volatile. So if you're into it for the longer term, then generally it is lower risk than it seems. Now, similarly, if you look at the 10-year CAGR or 8-year or 4-year CAGR for car sales in India, they're remarkably stable, because they're driven by structural aspects like new household formation, rising road network, the fact that petrol prices versus CPI have been pretty normalized very sharply in the last 3 years. So all of these factors are supportive. The only risk with discretionary now is that it is as big a consensus buy as I can think of. Everyone I see talking about how discretionary is the best play in the world, which is a bit of a risk in terms of valuations. But from the perspective of growth, I still think it's a good sector to be in.
Okay. We have your note with us, Neelkanth, and you have mentioned a lot of cyclical stocks in that note. You mentioned, a lot of consumer buys in that note. You mentioned Colgate, you mentioned Imami, you mentioned Marico. Within the auto stocks, can you give us a little more color? In fact, we've got a money control question. Our money control borders can send their questions to you. One Siddharth writes to us from Udupi, and he says he has some investment in TVS Motors. His acquisition price is actually 231. He wants to know whether he should remain invested in the stock. But okay, I'll make it more broad for you. What kind of auto stocks do you like?
So we like cars, we like commercial vehicles,
Okay.
We don't really, I mean, so within the auto sector, we're not particularly positive on two-wheelers. There are two-wheelers, see, there are stocks that we don't cover, and in any case, I think it's very hard for me to specify stock names because we are only trained to advise and legally authorized to advise institutional investors. So I can't take stock names on public media platform, but I will say that there are stocks which with better management where, and two-wheelers move on brands. You have a good brand, a good model which gets launched, and for 1 or 2 years your profits go up very sharply. So there's some specific names in the two-wheeler side which actually still could look okay, but as a sector, given the competition, we are slightly cautious. On the car side, I still think there are some names which look very attractive. On the commercial vehicle side, in particular, after I think several years of disappointment, we are starting to see commentary or on the ground data. I mean, again, freight rates moved up again last month. What some of the larger companies are saying is that spare part sales, which had slowed down very sharply, which meant that trucks weren't running, so spare part sales are starting to pick up, which is a very healthy sign for the broader economy and for the CV market.
Neelkanth, you look at pharma very closely. It's one of your favorite sectors per se. This is a sector where we in CNBC always call it, it's a sector of landmines as well as gold mines. Going forward, which stocks do you like in the pharmaceutical sector? How have you read the recent developments at Sun Pharma and the 483 at the Halol facility?
Right. At least, see, the higher regulatory scrutiny can potentially create landmines in some stocks where a large percentage of your production comes from one plant, or you're completely focused only on one market, the US, and if you have an import alert, then there go your profits and growth for the next 2 years. So I think the higher FDA inspections have been a big drag or overhang on the sector. It hasn't hurt the performance much so far, but especially except for particular stocks. But I think it is also a reflection of how systemically important Indian suppliers have become, the Indian sector has become for the US market. So the FDA necessarily needs to invest a lot more into more regular routine inspections in India, and for the longer term health of the Indian sector, I think that is actually not a bad thing. I wish the Indian regulator was doing the same thing. That the sad reality that the same company runs 2 different plants, one with much lower compliance requirements for the Indian business and one for a much higher compliance requirements for exporting to Europe and the US. So anyway, so I think for the medium term, actually, it is not a bad thing at all. It will increase some of the costs, but the basic advantage of Indian companies is cheap chemists in India and a flourishing ecosystem with several thousand, 20,000 companies in the sector, and I think that is a competitive advantage which will not go away. But the sector as a whole is something that we have liked for a while. It has done exceedingly well in the last 3-4 months, and I think some of the stocks are looking very stretched. So we have outperformed on many stocks. Very hard for me to name them, but because I'm not allowed to.
Yeah.
But I would say that some of the names are looking stretched now. If you are into them, there is no point selling them because these are very long-term growth stories. When I used to be a pharma analyst, I used to say this is a 10-year growth story, and well, I still think it is a 5-7-year growth story. Most of these names have learned how to manage international businesses. They have exceedingly smart management. The big challenge for some of these, the largest ones, used to be management bandwidth. I think they've addressed that wonderfully. That shows how good Indian entrepreneurship is. And so these are very long-term structural stories. If you own them, hold them. I would be cautious about buying them. If you're looking at 3-4 month returns, I think there are phases. And when I used to be a pharma analyst, I mean, I remember even stocks we absolutely love and adore. I mean, they will give you 3 years of performance in 1.5 years, or 2 years of performance in 6 months, and then they will sit there for 1 year. And some of these stocks look like they are in that stage right now. So I'm not very clear if I would be adding to positions right now.
All right, Neelkanth, one final question to you. You said, I think, 3-4 times that the broader markets will do very well. Give us an idea what kind of an outperformance the mid-cap index might give, for want of any better index, over the large caps. As well, some broad guidance on how should we choose mid-cap stocks. How would you play the internet boom, for instance? Do you like the logistics companies? Give us broad categories that you will look at in the mid-cap space.
Great. See, I think given where India is and given how the business model itself is changing, so there is a move from a very clearly crony capitalistic model to a more general business friendly model. And I think given the way India is changing and how urbanization is happening away from the big cities, and we've talked about the silent transformation, etc., repeatedly on this show, I expect that growth will be more bottom-up, and you will find more and more companies from small towns focused on geographical niches or product niches which are coming through, getting listed. And that is where I expect that that the mid-caps as a sector will do very well. The price to earnings multiple, so back in September, October last year, we had written how the price to earnings and the relative performance of these indices versus Sensex and Nifty were at multi-year lows. A lot of that has corrected and in very short time, but I expect that the growth going forward will still be much stronger. In particular, I mean, if you're choosing, I think it is what is important, and we've done this chart which I still find useful, which is if you plot on a scatter plot, I mean, so on the x-axis you plot 5-year CAGR returns, on the y-axis you plot 1-year CAGR returns, you almost get a straight line. Right? So effectively, the companies that deliver returns over 5 years are the companies that deliver returns over 1 year, and there are companies that lag on all fronts. So if you have either companies in good niches, logistics, as you said, is, I think, going to be a growth factor. I don't think we are going to have much of a modern trade revolution. I think we are going to straight away pass through to internet, and that means a lot more movement of goods. Some of the larger internet companies may want to do their own internal logistics because that is where they think there is differentiation, but a large number will actually look out to do external. And I think that's, again, a good sector, a good niche to be in. There is, waste management in China, for example, solid waste, liquid waste, air purification. These are very hot and growth sectors. In India, you will see something similar, say water processing. We are actually using a lot more water than we are on our team. Ananta put out a great note on explaining how India stands on the water side. We think we have a lot of water. Actually, we are using a lot more than we think we do. And therefore, some of those sectors are secular growth sectors. So if you are in some of those sectors, I think even expensive valuations perhaps can be justified. If you have good management, I mean, in mid-cap companies, effectively like a venture capitalist, you need to focus on that. If you have any doubts at all about the quality of management, that their appetite for growth is going to weaken or that they're going to get greedy, I think then one shouldn't compromise on quality, and it is better to look longer term on some of these stocks and not look at trading them because the moves can be very volatile.
All right, we'll leave it at that. Neelkanth Mishra, it's always a pleasure speaking with you. He doesn't give us, doesn't catch the fish for us, but certainly tells you how to catch the fish. Thank you very much for joining us. Pleasure speaking with you.